What is goodwill impairment? Have you ever wondered what happens when a company's goodwill is no longer worth what it once was? Goodwill impairment is a key concept in accounting that addresses this very issue. Goodwill is an intangible asset that arises when one company acquires another for more than the fair value of its net identifiable assets. This excess amount is recorded as goodwill on the balance sheet. However, there are times when the value of this goodwill can decline. Goodwill impairment occurs when the carrying value of goodwill exceeds its fair market value. This situation indicates that the asset is overvalued and needs to be adjusted downward. Companies must conduct an impairment test at least once a year or whenever specific events suggest that goodwill may have lost value. These triggering events can include adverse economic conditions, increased competition, legal challenges, or even the loss of key personnel. If the fair value of goodwill is found to be less than its carrying amount, an impairment loss is recognized. This loss is calculated as the difference between the carrying value and the fair value of goodwill. Once an impairment loss is identified, it is recorded as an expense on the income statement. This reduces the net income for that period. Additionally, the carrying value of goodwill on the balance sheet is adjusted downward. In some cases, if the impairment is significant, goodwill may be written off entirely. In the context of consolidated financial statements, goodwill impairment affects the reporting unit to which the goodwill is assigned. This impairment loss will reduce the book value of equity and provide a more accurate valuation of the acquired business within the overall consolidated entity. From a tax and accounting perspective, goodwill impairment has specific implications. While the impairment charge lowers accounting income, it does not automatically translate into a tax deduction for that same period. The tax treatment of goodwill impairment can vary. In some cases, it may involve amortization over a specified period for tax purposes, which differs from how it is treated in accounting. Companies must be diligent in accounting for any deferred tax liabilities or assets that arise from the differences between the book value and tax bases of goodwill. Goodwill impairment is an important process that reflects a decline in the expected economic benefits from an acquired business. This adjustment impacts both the income statement and balance sheet, requiring careful consideration in financial reporting and tax accounting.